Hey, what's going on, Cash Flow Hackers? It's Chris with Life 180, and I am here with Melanie Sigma.
Hello, hello.
Stop Tax Strategist. And, we partnered up with Melanie and her company a bit because there's a lot of information out there when it comes to tax strategy.
Yep.
And it's something that we've been looking for a long time because there's so much, I'm going to just call it bad information.
Yeah.
Right? Misleading information. And one of the things that drives me crazy in the financial space is misrepresentation of the way products and strategies and whatever work. And so one of the topics, and we're going to be having some fun today, filming some videos. One of the topics is how to write off your lifestyle.
Yeah.
And with that, it's there's a lot of information out there. I mean, I'm on TikTok, I'm on Instagram.
It's all over.
We're all there, right? and there's so many 30-second, 90-second videos about do this, it'll save you millions of dollars and all this stuff. So I thought it'd be fun to actually do a deeper dive, more expanded video on what you can do and what you cannot do to actually write off your lifestyle. Because let's face it, I'm an entrepreneur, you're an entrepreneur. Like our typical client is entrepreneurs, real estate investors, and I think part of the game, part of the fun of being an entrepreneur is being able to write life off.
It's a wonderful part.
Right?
Yeah.
Right? And I think that's a big appeal. It's a big attraction to people. So let's spend some time going through some of that and what you can write off, what you can't write off as a tax strategist. And, you work with, your dad and company that helps people actually do these filings and you probably see the good, the bad, you see the audits, you see
seen it all.
The mess, right? And so let's talk about that. So before we get there though, I'd love for you to kind of like just make a little introduction about yourself, who you are, like what your company is, what you've been, just what you're all
So one-stop tax strategist, we bring peace to taxes and purpose to profits so that our clients and our employees can live more, so to help you live more.
Nice.
The purpose of why people get into business is so that they can have more time, freedom, and fun, right? And so we just see ourselves as a conduit to help them get there faster.
I love it.
And so we just really think about intentional tax planning. And part of that is educating our clients on what they can write off, what they can't. If it's a questionable thing, what they need to do to make it deductible.
Love it.
And then just making sure they're in the best structure and plan possible.
One of the, and we'll go deeper on this, but I want just like a little bit on it in this video is one of the challenges, I think, is there's so many ideas on what you can do to create write-offs, but there's also nuances to make it so you can actually take advantage of some of those things.
Oh yeah.
Right?
Yeah.
And can you talk about like a little bit about what you see about the danger of some of these ideas that maybe are legit, but are also dangerous? Like if you would just like listen to a TikTok video and implement it.
Yeah. So we always say like taxes and tax planning is kind of like having the IRS playbook. And so you just have to know what the rules are to be able to win the game.
Yeah.
And so just thinking about, like, I've seen some people on TikTok, it's bad advice is everywhere. There's some good advice too, but then other things, it's like, I've seen somebody say they could save somebody $1 million and all they did was the Augusta strategy, which is where you can rent your house to your business for 14 days tax-free. And I can tell you that won't save you $1 million. So I've also seen a lot of people will send me videos and go, is this true? Is this true? And you just see, I don't know, just some bad advice, just of what I don't know if you're going to hire kids, different things like that. There's just ways to do it that will make it legit. I've actually worked with some life insurance agents that say everything is deductible because my entire life is a write-off. And there is some legitimacy to that, but the IRS doesn't necessarily see it that way. And so what we like to do is to pick through things, see what we can pull out. And sometimes it's not, is this deductible? It's how can we make this deductible? You know? So if you're going on vacation with your family, what can you do to structure the vacation so that it is a business write-off rather than just saying, well, I brought my laptop and I worked.
Right. No, that's awesome.
Yeah.
So there's a couple things. We were just having a conversation about golf.
Yeah.
Right.
Yep.
Golf memberships. So thank God I don't play golf anymore. I don't have time for it. But there was a time when I first got into the insurance business. I was a member at a country club, Vermont National Country Club in Vermont, and I wrote all my golf off.
Yeah.
Thank God I didn't get audited for
Yeah,
it.
yeah.
Because you just told me like golf is not a write-off. My golf membership, my country club membership.
Mm-hmm. Social memberships, gym memberships aren't deductible. With the gym, there's some ways to do it, but you have to get like a prescription from your doctor.
Okay.
It has to be a new gym membership, and you have to have like a new medical condition. So that's kind of
You
where.
don't want that. Let's be real. Like,
No,
that's not something anybody
exactly,
wants. You don't want to
exactly.
pick up a new membership,
Yeah.
a new medical condition just to get a membership.
And so the golf itself would not be deductible, the golfing itself, but like if you're wearing your business clothes, the clothing could be deductible. If you're eating a meal, the meal could be deductible.
Okay.
Drinks could be deductible.
So I'm a YouTuber. Can I deduct my clothes that I wear for YouTube?
If there's a logo on it.
If I put my logo on
Yeah,
it.
yeah. So it can even be a small little logo.
Small little logo.
Yeah.
I'm gonna get a little
Yeah.
Life 180 patch and put it
Yeah,
on
there you go.
Yeah. That's awesome.
So clothing with that. So a lot of people like to push the button, and everything's a deduction until you get audited, and then you
Not
really
illegal
find out.
until you get caught, y'all.
Exactly. So just know that you're
But
rolling.
if you get caught,
Yeah.
you better be ready, right?
Know that you're rolling the dice.
Yeah.
And then sometimes there's just ways to, like golf membership, for example.
Yeah.
If you're taking your team, if you're buying just a pass to take your team on a team event, then yes, that would be.
Okay.
But just not clients.
So a specific event or outing could be a write-off for like a team building event.
Yeah.
But not a country club membership.
Yeah.
And how about this one? This is what we just talked about. I can't take one of my top clients out
No.
and go golfing.
No.
I think that blew my mind, actually.
I know,
Like,
I think it's silly.
Most people are not prepared for that.
Yeah.
It's kind of dumb.
It is,
in a
because it's
way.
actually a legitimate thing.
Yeah.
But the IRS, the rules are the rules, and hopefully they'll change at some point. But you just.
But it's been that way for a long time.
Yeah, and it's just not worth it. There's so many different ways you can tweak other things in your life. My dad always says pigs get fat, hogs get slaughtered. We just want to be chubby. So let's be chubby little pigs, not big fat hogs.
That's awesome. All right, so let's go deep into this then. What are the ways that you see, the most common things that you're seeing that people are maybe trying to write off, aside from golf, obviously, that they're trying to write off, or that they're writing off? They come to you, they've been, maybe working with somebody else, or maybe doing their own taxes, TurboTax, that kind of deal, writing stuff off, and you look at their stuff and you're like, well, we better hope you don't get audited because you're totally exposed right now.
I think a lot of it is not even what they write off. It's just the not having the proper documentation in place.
Okay.
And so even like a business meal, for example, it could be a legitimate business meal, but you don't take a picture of the receipt. And so on like a meal receipt, you need to write who you met with, what you discussed, take a picture of that and have that in your records. Otherwise it'll get thrown out in an audit. Your eyes.
Crap.
So, so all of that, it's if you don't have documentation, like a lot of people think bank statements are enough in an audit.
Yeah.
You might be learning something.
Yeah.
Bank statements are not enough in the event of an audit.
Okay.
That'll get thrown out. So you need to have just like the purpose of the write-off, and then yeah. So you might be learning.
So what are some areas that people are missing and that they could write off that they're not taking advantage of? So maybe
like
strategies.
Vacations are one. Like
Awesome.
if your spouse doesn't work in the business, but you can justify a small wage, you can put them on for maybe a couple, like $500 a month.
Yeah.
And then now you're taking an employee on a vacation.
Okay.
If you put your kids on the payroll, then they can be on a vacation. And then what we like to do in our family is just have a partner planning retreat. So we just go to Hawaii, and then we want to get off site to be able to think through our planning more clear. And so then we just take the family. My kids are they're my models for my business.
Nice.
And then, all of us work in the business, so it allows us to write it all off.
That's awesome. So I just bought this Jeep Gladiator.
Okay.
Right. Can I slap like a big Life 180 logo thing?
So it doesn't have to have the logo. It's the same whether you slap the logo on or not. If you slap a logo on it, all that's deductible is the logo. The car is deductible
No matter what.
no matter what.
Even if I own it personally?
If
I
you
guess
use
it's
it
an
for the
LLC.
business, so
Okay.
you can have your business reimburse you for
So the
a
fact
business.
that I'm like doing my speaking tour right now and using it to drive from thing to thing
That's
to
all
thing,
deductible.
all the mileage is deductible. Is it smarter typically to do the mileage or to do the car or to do like how do you like? I mean, I guess it depends on how many miles you're driving.
So actual is actually almost always better. So my dad's run the calculations on all that, and actual usually is better.
That's awesome. That's amazing. So that makes me feel better about having like.
You should have gotten
I should have bought a bigger truck.
Should have been 6,000 pounds. Then you can do the 100% bonus depreciation, get it all off against the entire cost of your Jeep would have gone against your income.
So how does that work with electric cars, like a big Rivian that are much heavier because the batteries and all the things? Like we were literally on the way here talking about buying an RV trailer because we travel so much.
Yeah.
And when we come into the U.S. and I'm driving around, like literally, I put on 5,300 miles in the last month.
Wow.
You know, just driving around and going from event to event, meetings.
Yeah.
You know, recruiting meetings, speaking, like all this different stuff, right? And so on that, it's like I'm spending $170 a night at hotels and all this stuff. It's
all
like,
that.
If I'm doing this 2 months a year, it makes sense to have the RV, like a trailer, to just pull behind so we could stop anywhere. Like, all right, so check it out. Midstream, we got Mr. Byron McBrew with us, who is actually Melanie's dad.
Yep.
And the lead CPA for the firm that they work with.
Yep.
And he's been off camera this time. We keep like looking over him and asking him questions and, you know, whatever. And it just turns out might as well just get him in the mix.
Pull him in.
And have these conversations because we're having, you know, all this stuff, and I think it's gonna have a better flow. And so we're gonna just add this to the mix and keep the conversation going. So there were a couple things that we've been talking about off camera. I don't have to feel guilty about my golf membership.
Yeah, exactly.
Because the golf membership change didn't happen until 2018, you said?
Correct. Yeah.
So that's cool. And then talk to me about like the car thing, because I think that's a big thing. Like every entrepreneur, business owner has a car.
Yeah.
They utilize it. Most people mix it for personal, for business, for whatever. When does it make sense, and what's the easiest way to kind of track it? Because I remember the worst situation I ever had. I'll just put it out there. I got audited.
Yeah.
And it was in 2014.
Yeah.
And I got audited because I was working at National Life Group. And I was driving all over New England and writing all this stuff off, but I didn't keep a good enough mileage log. And I got whacked for it.
Yeah.
And they would not take my mileage. Even though it was completely legit, I got smashed. And that's a big lesson for me.
Yeah.
So what's the best way to handle like when you have a car, how to write it off and insulate yourself?
What the IRS considers is they consider your first and last trip of the day non-deductible. So if you commute to your office, that's a non-deductible trip. Anything from the office is deductible.
Okay.
A lot of times what I have people do on that is you get a little P.O. box a mile from your house. You drive to the P.O. box, pick up the mail, and then all your trips after that are deductible. That's if you have a long commute.
That's fancy.
And then on the way back, you stop and get some office supplies, then go home the half a mile from there. So that's a good way to make your mileage deductible. We talked about doing mileage versus actual and all that stuff.
Yes.
And if you look at kbb.org, which is what cars cost and all that.
Yeah.
And I did this a long time ago when I had an Avalanche, or actually when I was looking to see what I was looking at getting a Land Rover.
Okay.
And they're notoriously expensive with the repairs. So, and I figured out that I could buy my Toyota Tundra with the maintenance costs that I would spend on the Land Rover. So that made it pretty easy to buy.
Yes, for
but
sure.
When I was looking at this, the cost to drive an Avalanche at the time was $1.18 or something like that a mile.
Okay.
And then at the time we were getting like 45 cents a mile for mileage.
Okay.
So it was almost 3 times more expensive to own a car than what the IRS would pay you for it. So most of the time you're better off to use the actual expenses, almost always, unless you have like an old car with 200,000 miles on it.
Got it.
And you've already written it off and depreciating it. And the interesting thing about cars is once you elect one method, you're stuck with that method for your whole life of the car.
For the car.
Yeah.
If you bought your G-Wagon and took 68 cents a mile right now on the first one, you'd be stuck never being able to write off all the actual expenses.
Oh, you can't.
Yeah, you can't elect
go
to
back.
go back.
If you made a mistake, could you refile and change it that way?
I think once you elect it, you're stuck with it. I'd have to verify that one. I'm not positive on that one, whether you can elect it if it was within the statute.
Okay.
But one thing we like to do is for let's say you have a big expensive car, lots of expenses.
Yep.
Let's say you drive at 80% business.
Okay.
And most of the time we can get 70 or 80% with no substantiation.
Okay.
Because we tell people to do logs, but nobody does them.
Nobody does.
Yeah.
And there's
I mean,
apps
I have
and
a
stuff
few
like
that-
that do it, but
I have a few that does
such a
it.
pain.
Well, he was told by an IRS auditor is to just track 1 month out of the year. And he always says to track
Track the
personal
not the
use,
business.
because then if you forget to write it down, it goes to the business.
Okay.
So that's a trick. And then if you do the 1 month, you can use that as a basis for
You get a
the rest.
percentage.
Yeah.
Okay.
Then multiply that times the whole year. And then what I like to do is most people are corporations with their businesses or entities or something like that. Is you're going to drive your car personally because you go get milk, you go to the grocery store, you take your kids to the movies.
Totally.
You do that.
Yeah.
But what you do is you take that personal use, and then you personally would reimburse the corporation for the personal use. So let's say I drive 10,000 miles a year, and 2,000 of them are business.
Okay.
Or personal, and 8,000 are business.
Okay.
What I would do is I would take the 2,000 miles times the 68 cents a mile.
Yeah.
I'd reimburse the corporation for $1,360, and that makes the car 100% deductible. So if I'm doing that with a G-Wagon,
That's
if I'm doing that, and with the bonus depreciation and all that, you have to have more than 50% business use to take the Section 179 and all that.
Yeah.
But this is the way to get it over the higher amount.
Got it.
That way the whole car becomes 100% deductible, all for $1,300 a year check that you write back to the company.
Wow, that's
And you look at a G-Wagon, a couple $100,000 car, the depreciation on that whole thing might save you, $80,000 on your taxes, or maybe even more in California.
and that's great, but that's great if you're paying cash for the car. It becomes
Doesn't matter.
Doesn't matter. You can still take it.
really
As long as you're not leasing it.
Yeah.
So if you're
Leasing it doesn't
financing
work
you
for
can
bonus.
still
Yeah.
deduct
I did that a
100% of the
few
car?
years ago with the Yukon. Yeah.
Really?
We had like a 0% loan for 3 years. So we were like, why not just do that? And I still got to take that.
So you took 100% of the depreciation of the vehicle, or the.
Well, at the time it wasn't 100% because it was going down.
Okay.
But now you can with the big beautiful bill.
So in year one, you do that. But
Well,
then
that
you
bonus, they have two things. They have one thing called Section 179, which is writing off, but you can't generate a loss with Section 179.
Okay.
So if you have a business, if you have real estate activity that you want to offset your wages, you can't do that with Section 179.
Got it.
But if you have a business that's making a profit, you can take the Section 179
and reduce your income.
and reduce your income.
So if I had $500,000 of income and bought a $200,000 car that qualified,
take
for
the whole car.
179, I take the whole car at 200, even if I'm financing it.
Even if your financing is irrelevant.
I could take the 200,000 off the 500, so now my taxable income is 300.
Right.
Just with that.
Now, the only thing is, though, if you leased it, at least you write off the payments. You don't write off the purchase.
For sure.
So you're better off to buy it.
Yeah.
And there's one good way to use the lease. What you do is you go in there and you say, let's say you're going to buy the G-Wagon, let's use that as an example. You'd say, I'm going to drive this, because normally you tell them how many miles you're going to drive and they give you a rate.
Yeah.
And then all that does is changes the buyout at the end of 5 years.
Yeah, they're charging per mile for the overage of the
Yeah.
10,000
And
a
it's
year.
fairly expensive. So what you do is you go in and tell them, I'm going to be driving this car 80,000 miles a year.
And they're going to charge. And
And they give you a massive payment, but your buyout is real small.
So even if you're leasing, there are ways to finagle.
There are ways to make it a lot better.
Ah, that's fascinating.
And so you could do that. And then because the thing with a lease, this is kind of technical, so
Yep.
it might be kind of boring, but
No, this is great. I mean,
With the
we're
leasing-
all into the technical, boring stuff on this channel.
Yeah.
with the leasing, what you do is you take the payment, and then you have to go to this chart and look up based on the fair market value, add some money back into your income.
Okay.
But the money added back in your income is based on the fair market value. So if my normal payment for that car might be $1,500 a month, but because of the mileage, it jacks it up to $7,000 a month.
Okay.
Now I write off $7,000 a month, and I still add the $500 a month add back.
Okay.
So that's a way to make that. It's a way to make a lease work a lot in your favor.
So a selfish question. We were just talking about the RV or the camper trailers, right? Being able to write those off, and you kind of gave some great answers on that. But what about the like the drivable, like the Sprinter vans, the stuff like that, where it's an RV? I remember I met it was a mentor of mine who bought one of the Sprinter vans that was an Airstream,
Yeah.
200,
Oh, yeah.
200 grand.
Yeah.
Like really baller setup, whatever. But it was a complete write-off. Is like a mobile office, and he had it like set up. I don't know if it was legit or not, but that's what he did.
I have a guy in financial services.
Yeah, he sends financial services.
He sends me a lot of dentists, but he actually uses his, like, he likes to ski, so he'll go out to a ski resort and work.
Yeah,
Get the powder in the morning and then work in the afternoon.
Yeah,
and you can make it. Everything is really based upon what your logbook says and what your documentation says.
Okay.
And we actually have an IRS auditor that works for us right now.
Yeah.
And she basically said too, it's all about the documentation.
Okay. But with that, is it the similar? Can you qualify for Section 179?
Yes, you can.
With a big RV because it's heavy enough.
Yeah.
You can. So you could buy one of those for $200,000, and it's effectively a tax write-off.
Yeah.
If your logbook is right. It's really all about the logbook.
And I'll touch on this.
What if you have no logbook? Because you just bought it.
Then
I
you're
bought it at the
paying.
end of the year to get the deduction.
They'll fill in the blanks.
Your logbook's only for 4 or 5 days,
Oh, okay.
and it's just based on the mileage that you drove during those 4 or 5 days.
Okay.
Years ago, we bought a BMW X5, which is right over the 6,000, and then we bought it fully 100% financed, no money down, and for $70,000, and we were able to take the whole 70 off that year. And I'd probably driven it, 20, 30 miles by the time.
I got to see what my Gladiator weighs. Do you think it qualifies? I got to check.
Gladiator.
I got to check.
Yeah, check it. You can always Google it. Gross vehicle weight of
Yeah.
Gladiator.
That's good. That's good.
And I'll touch on this too, because a lot of people think, oh, you're writing it off, so you think you're saving all this money. And yes, sometimes you are. Sure. But you're still spending money to save it. And so the way to determine how much it's going to save you is you can figure out your tax bracket. If you need help with that, we can always help with that.
Sure.
But then you multiply the deduction by your tax bracket, and that will tell you what the actual savings are. So I like to think of it, let's say you're in the 30% bracket. Sure. And let's say it's a $100 write-off. So you're going to save $30 by writing that off to your business. Sure. And so it's kind of like a 30% discount.
It's a big deal though.
Yeah.
Like if you're buying a $200,000
It saves a lot.
Sprinter van or
Yeah.
a $100,000 Sprinter van,
Makes it a lot cheaper.
it makes it a $70,000
Yep,
Sprinter van.
exactly.
Like that's
Big deal.
a big deal.
Yeah.
Like
Yeah.
a big deal.
Yeah. So that's where it's important to document it all properly so that it holds up.
Are there any other lifestyle things like paying your kids?
We got all that in our Live More tax solution, and it's basically you can. First step is to lay the foundation, have a good set of books. This goes back to documentation. If you don't know your numbers, we can't do tax planning. So tax planning is only as good as your numbers. The next step is identify the right entity.
Yeah.
And so this actually goes with the auditing too.
Okay.
And basically, depending on what entity you're in, it can save you money on taxes, but it can also increase or decrease your audit risk. So an S Corp, by being an S corporation alone, you're making yourself about 7 to 10 times less likely to be audited than if you were a single member LLC or a sole prop. So little things like that. What's your trick with the partnership with the spouse?
Oh, I had a client that was buying a fishing boat, and he was going to lease it out and rent it out and have a fishing boat, and he was going to do it for himself and lease it back to the charter business, And I said, well, that as a sole proprietor, he was in like and he makes over $1 million a year. Yeah. He's like in a 3.4, 3.5, 3.6% audit rate.
Okay.
But if you put that boat into a husband and wife partnership, now it goes down to a 0.4,
So
and even lower.
The chance.
Yeah, it's tenth of the chance to make it so your audit risk goes down. They just don't. They really don't have. The IRS doesn't have the personnel.
Yeah, they're overwhelmed.
To overwhelm. And now
They are.
with the big beautiful bill, I mean, how they were talked about hiring 87,000 agents.
Yeah.
That went away with the big beautiful bill.
Did it?
Yeah. And also, people that are making about 300,000 or 400,000 are the number one target.
Yeah.
300,000 or 400,000 and up.
Yeah.
The IRS is starting to go more after big hitters because by the same amount of time they can make a lot of money, so they get a higher rate of return on investment.
That's all.
Versus if you audit a poor person, even if you catch something, there's no money involved anyway.
Makes a lot of sense.
Yeah.
Makes a lot of sense. Well,
Going back to the Live More solution, if you want, this kind of ties all into the lifestyle.
bring it all in above.
So the V is venue your home. So the Augusta strategy that we talked about earlier. So that's where you can rent your space, your home. It has to be a primary home, and you have to have an entity outside of you being a single member LLC or a sole proprietor.
Okay.
And so you can rent your space to your business for corporate board meetings.
Cool.
And so that's 14 days. Anything above 14 days gets taxed. Anything below 14 days or 14 days and below is
And
non-taxable.
what is considered reasonable for the Augusta rule?
So
you
look
just
at
kinda
fair rental.
Airbnb rates for
Yeah.
your area.
So he has a home worth about $1 million. So we do like $1,000 a day times 14.
Okay.
So it's
$14,000 right
$14,000
Yeah.
tax-free. Doesn't suck at all. No. And if you have a second home,
$3,500
Yeah.
grand.
yeah. So if you have a second home, you can do that too.
You can.
Yeah. As long as the meetings are reasonable. That's the biggest thing.
28 meetings is a lot.
Depending on, unless you have a couple entities.
I have a lot of businesses.
Yeah.
You do, so that,
A lot of I do a lot of meetings.
yeah. So if you actually do, that's where the pigs get fat, hogs get slaughtered. If our sniff test is looking an IRS auditor in the eye.
Well,
If we could
for me, it would. Yeah, I mean, for me, it
say it
would be
without
like
cracking a smile,
when we
you can.
recruit, when we bring people in.
Yeah.
I could, I mean, that's a whole deal.
Yeah.
Entertainment for those kinds of meetings, like bringing them in
Right.
and
Yeah.
having actual.
Yeah, for sure.
That's
Yeah, so that's legit.
Okay, so that's the V.
And then a lot of people ask, just to touch on that, to go with the writing off your lifestyle.
Yeah.
They ask home office versus Augusta.
Sure.
We've ran numbers on that, and Augusta rule wins almost every time.
So you can't do both.
You can't do both.
The reason why you can do both, there's a way to do it.
Okay.
Okay. The reason why is because if you're doing home office, you're renting your little office all year long. So with the Augusta rule, anything over 14 days is fully taxable. Makes everything taxable.
Yeah.
So what you do is you do the Augusta rule, and then you have, instead of renting the home office, you do a reimbursement to you for the home office expenses.
Got it.
So you do an accountable plan for the home office,
Got it.
and then couple it with an Augusta rule.
Got it.
And that makes them both deductible.
Okay.
And there's also, you said one exception. Is that when you're doing like home renovations? Is that when it would make sense to do?
Yeah, what you do, let's say you're getting ready to remodel your home.
Sure.
Or do a lot of repairs, because those are deductible.
Yeah.
On that year, you'd want to actually do the home office expense and not the deductible, because let's say you're going to spend $200,000 in renovations, on repairs, and then you'd basically do that and take a percentage of those deductions, and it'd be more than the Augusta rule.
Got it.
Yeah.
Got it. You
So that's
can
that.
take home renovation deductions for your business.
To a certain extent. It's based on the portion of the home that's deductible.
Okay.
So like, for instance, I had a client in Sacramento, and he had a 2-story place. The whole bottom store was pretty much garage and man cave.
Okay.
And the up store was where he lived. And what we did, he owned a trailer company. So he basically used it as storage for all of his extra surplus inventory.
Got it.
And that way he wrote off half of his home, including all the repairs and all the maintenance and everything to do with the home. So that made him have a lot. I had a lot of guys that they're, bachelors, they might have 40, 50% of the house as a deduction, where if you have 3 kids running around the house, you're not going to have 40%. You're going to have maybe 10 or 5 or 7%.
Yeah.
A lot smaller amount.
That's fascinating. One of the things we're thinking about, I have no problem putting this out there 'cause it's kind of fun. Other people might think about it the same way. We've been debating getting an office space or buying a house and using it for business use.
Yeah.
Right? And using it for entertainment, using it as like a YouTube studio, using it as like virtually like full on business. How does that work?
Well, it would be based upon the percentage of how you used it.
Yeah.
Again, your logbook. Your logbook and documentation is all good.
Really? So you could do 100% of it?
If that's what you'd have to have another home.
You
You couldn't live. You'd have to have another
It would
home.
be 100% business.
Yeah, but that'd be legit. If you have 2 homes and you're just using that one, and you go there every day for business, you get all your mail there. All the facts and circumstances.
The zoning doesn't matter.
No, zoning doesn't matter. No,
Really?
nobody's going to question that. It might matter to the county if they're.
It might matter to the HOA. They may have rules.
Yeah.
whatever, but- so you got to be careful about that. And that's
Yeah.
one of the things
People
we're
checking you
discussing.
out. That's that
Your neighbors and stuff. You got a whole different set of problems to deal with if you go that route. That's one of the things we've been contemplating. But, I figure, why rent a place?
Yeah, it's homey.
Not only that, why rent a place
Oh, yeah.
when you could own the real estate for the same price
Yeah.
as rent, basically?
Well, purpose-
And you're getting the appreciation, all the value
All that.
of owning the real
But a
estate.
lot of times the purpose of a business is to pay for real estate.
Yeah.
And if your wife qualifies as a real estate professional, then you get the bonus depreciation on
is a
that.
real estate
Yeah, so she would get the bonus depreciation against your income. So, yeah.
Have you guys ever talked about cost what cost segregation is?
Yeah, but
Okay.
get into it.
You want to go, or I mean?
Yeah, so basically any property that you buy, there's different sets of depreciation. So if you're not a real estate professional, it would just get depreciated over time, and it would be in a passive income bucket. So the way that you're taxed with your business is active income. The way that real estate's taxed would be passive, unless you're a real estate professional. If you qualify for the real estate professional in the eyes of the IRS, it turns that passive income into active income.
Yep.
And then it also allows you to do a cost seg study, which basically it breaks apart all the different pieces. It's an engineer study that breaks apart all the different pieces of the property.
Nice.
And instead of it, like a roof depreciates over like 27 years, it would accelerate all those different pieces up to the first 3 to 5 years.
So you need to, like, how does the IRS, for those watching, quantify or qualify you as a real estate professional?
750 hours or more in real estate related activities.
Okay.
Material participation, which we have a thing that we can send out for that.
Okay.
But just like bookkeeping for your properties, researching new properties, going and checking them out. There's certain things that, basically managing the properties.
Okay.
And then, but we have a write-up that we can send
Amazing.
out
So
details on that.
It also has to be more hours than any other.
Yep.
So if you have a W-2 job for 2,080 hours a year, it's going to be very difficult to become a real estate professional.
It's got to be your dominant.
It's got to be your dominant, and just one of the spouses.
So being a real estate professional is not just having a license,
No.
right?
No.
If you have another job.
That's key. And you don't have to have a license either.
You don't have to have a
No,
license.
you don't have to.
All right. But
It could be construction. It could be different workers, as long as it's real estate qualified.
Let me touch a little bit back on that, the cost seg and bonus depreciation.
Yeah, please.
What the cost seg does, normally when you write off a piece of property, you write off for 27 and a half years straight line.
Yeah.
Okay, what the cost seg does, it breaks out that property to 27 and a half, 20 years, 10 years, landscaping's, I think, 15 years.
Well,
And like leasehold improvements are there. Carpet, doors, drapes, everything. If you look around, you see a lot of different things that are really personal property.
Amazing.
You can write some of that off over 5 years, 7 years, 10 years, 15. But anything under 20, you're allowed to take in year one. So if you bought, the way the numbers work, if you bought a $500,000 home, we take 20% of it for land, say, which would be $100,000.
Yep.
We take that $400,000, and probably 25 to 30% of it you could take in year one. Okay. So by buying a $500,000 home, you could probably get about $125,000 deduction in year one.
it's pretty sweet.
And then the key is you just have to actively manage it for the first year. After that, you can turn it over to a property manager.
No, that's just with the short-term. Yeah, so the loophole, he's talking about the loophole around if you can't qualify for the real estate professional.
Sure.
If you, let's say you have a W-2 and your spouse owns a business, and so neither of you qualify, you could do a short-term rental. And so if you self-manage a property as a short-term rental, so 14 days or less, or actually, is it 7 days or less to qualify as a short-term rental? So 7 days or less is a short-term rental.
Okay.
And then if you self-manage it, then you can qualify as long as you only do 100 hours. So you have to only do 100 hours. So that could get the property up and running. And as long as you rent it out or it's ready for rent, then you can still do it.
Huge tax.
Yeah.
Amazing.
Well, you take a guy that's a dentist or something like that, making good money. Like I'm not a real estate professional just because I do more time in accounting. But if I could do a short-term rental, then I could take that $500,000 house and get $100,000, $125,000 deduction
So
my return.
So this is probably a different video, but I'll stoke the flame here. One of the things I've been doing on TikTok is battling with all these private.
Oh, I've seen that. Yeah.
Makes my head explode.
Yeah.
Like these guys are buy term and invest the difference, put your money in mutual funds, just buy and hold and whatever.
Yeah.
And all they're doing is talking return versus return. And I'm like, guys, it's so much more than that.
Yeah.
When you look at the tax benefits and like utilizing whole life insurance and real estate and the tax benefits and the returns, and they just don't get it. So maybe we should do a video on like the actual tax advantages on real estate. When you do it the right way, because that is super powerful.
Yeah.
And we'll go from there. So are there any other lifestyle, like really in your face lifestyle stuff that you see people that you think everybody watching should know about before we close this up?
Yeah, so if you support your parents, this kind of goes back to the Live More framework, which we can circle back to on another video. The M is move income strategically. So this is where you look at the lower tax brackets around you.
Okay.
My dad, for example, my grandma is like 92 years old now. 92.
Okay.
She's at the lowest tax bracket in California. He's at the higher. And so basically he opened up a separate corporation. She's a passive shareholder of it.
Okay.
And he is the officer, so he does the work within the company, but he hires that company for services.
Yeah, makes sense.
For like 80 grand, shifts about 80 grand of his income to her bracket, saves him about 40. And then she pays like 10.
Okay.
So it's a net profit of about 30. And then he just gives back, has her keep half, gives back the rest. So he supports, makes a profit on helping my grandma out.
That's amazing.
Yeah.
I'm the fair-haired child.
Yeah.
Get a profit on it.
That's a
There
good,
you
yeah,
go.
yeah.
That's awesome.
Yeah.
And really, for someone just on Social Security, you know, I give her $1,600 a month, and that changes her life.
Yeah.
Totally.
Yeah.
That's amazing.
It really
And
makes
there's no net cost to you ultimately.
No, it's profit. It's a profit. And then also, like, if you have kids that go into college, even kids above 18 that aren't going to school, but if they're at a lower bracket, all that can work. Baby mama plan, if you got, you know, kid with somebody and you're not married, they have a lower tax bracket, take advantage of it.
Yeah.
Mhm.
You just got to have a good relationship. with them.
Exactly. Yes. Yeah.
Well, you just
Yeah.
make it so that the company has no value. Pull the rug out at any time.
Yeah.
Yeah, that's good. That's good.
Yeah.
Awesome. Well, this has been valuable. This has been fun.
Yeah.
So guys, if you haven't already, make sure you subscribe and hit the bell that way you're notified every time we launch a video. We're going to be doing a whole series. I'm here all day. We're going to be filming a bunch of stuff. I've already got all sorts of ideas going through my head on new videos to film. Are you guys on YouTube?
Not yet.
Not
I need
yet.
to be. Well, we have some like podcasts. I'm more on Instagram.
All right, so Instagram. So I'm going to put their Instagram link down in the description
Yeah.
below, and you can follow them there.
Yeah.
It'll be really valuable. And so until next video, make sure you subscribe. That way you're here to see it. We'll see you then.
All right.